Hi, it's Paddy Hirsch at Marketplace. If you've ever played the game Chutes and Ladders, then you know how to interpret the yield curve. In fact, even if you haven't played that game, it's actually pretty easy to do because the yield curve is nothing more than a line on a graph that shows the difference between the rates on short-term bonds and the interest rates on long-term bonds. So what do I mean by that? Well, here's a yield curve, right? Here's just a line on a graph, and it shows short-term rates like the 3-month bond yield. And then you've got the 1-year bond yield, then the 10-year bond yield, and then the interest rate on the 30-year bond. And this is a normal yield curve where you start to see that the short-term rates are lower than the long-term rates. And in an inverted curve, the short-term rates are higher than the long-term rates. And in a flat or a humped curve, all right, well, you've got a little bit of both going on here. Now, investors and economists like to use the yield curve as a kind of predictor of what might happen in the economy because it shows you how investors are investing in bonds, what kind of bonds they're buying, and how much they're being compensated for buying those bonds. And it's great to have the yield curve because it basically paints a picture. Instead of having to know where all the data points are, the picture's there right in front of you, and it allows you to see what investors think is in store. So what's this whole chutes and ladders thing? Well, if you've ever played this game, you'll remember that ladders are great. It means you're moving up in the world. If you hit a chute, it means you're sliding back down. So if you look at a normal yield curve, there's this hill that you have to climb. You've got to climb up, so you're going to need a ladder for that. So that's a good sign. So in a normal yield curve, it's a sign that the economy is going to grow. And by the way, the steeper the yield curve, it means the quicker people think that the economy will grow in the future. An inverted yield curve looks a lot like a chute. All right, when you see this, you know that investors think that the economy is going to slow down or maybe even contract. And in a flat or a humped curve, well, you're getting a little bit of both. It means that nobody really knows what's going on. So when you hear about the yield curve flattening, which does happen when you listen to the news, it means that investors are uncertain about what's going to happen in the future. Now, if you are thinking about using the yield curve as an investor yourself, you've got to be a little bit careful because investors, when they're buying these bonds, they're always reacting to different types of news and analysis. It means they're changing their minds all the time and buying different types of bonds, and that means that the yield curve is constantly moving. It's one of these situations where you could find yourself starting the day thinking you're climbing a ladder, end the day finding out that you're actually sliding down a chute, and that's going to leave you very